It's Friday, just after the close. We did it. It took 4 months to break to another all-time high, but as of the close Friday, the S&P 500 and NASDAQ are in record territory. Look, it's a line in the sand, but clearly the sentiment has turned from the glass is half empty to half full. Nothing changes sentiment like price. And all of this happened without some of the Mag 7 pulling their weight. The market cap leaderboard, that's changing too. NVIDIA, number one, takes the crown as the largest company on the planet. And Apple drops to third place. Now, take a lot for Apple to drop another notch to 4. I think right now the spread between Apple and Amazon may be $600-700 billion. But given how poorly this stock has performed this year, it wouldn't surprise me. The pain trade, that's higher. Driving shorts mad and forcing investors and portfolio managers to up their exposure. FOMO, fear of missing out, that's alive and well. 52-week highs, we have a lot of them. All right, all-time highs, we have those too. In tech, Broadcom, CrowdStrike, NVIDIA, Seagate, and others. Capital One in financials, Cameco and Williams in energy. And even in consumer discretionary, we have one, Royal Caribbean. Whatever is driving the sentiment shift, it's a far cry from the doom and gloom from just a couple of months ago. And I remember, I'm one of them. I remember how uncomfortable April was. Liberation Day. Well, we got liberated out of a lot of prices back then. I actually lost a bet with my producer, Chris Patty. He said we'd hit an all-time high a lot sooner than I thought. Well, I got to cut him a check this week. The strength in individual stocks, not a surprise. But what is a surprise is the strength of the index. When you have big companies not pulling their weight in a market cap weighted index, it tells you how powerful this move really is. So what's driving the action? Is it AI, the potential for peace in the Middle East, the Fed ready to cut rates, or all of the above? Let's dig in and find out. Welcome to The Money Runner. I'm David Nelson. Remember this, no matter how the day closed Friday, it's important to remember we're always one tweet away from an air pocket. In a Truth Social post, Trump announced he's terminating all trade talks with Canada. I'm going to repeat that, terminating all trade talks with Canada, citing what he called an egregious digital services tax. His words, a direct and blatant attack on our country. By the way, that came out before the market closed on Friday, and we still hit an all-time high. The tax, set to take effect Monday, targets revenue earned by U.S. tech firms from Canadian users. What's interesting here is it's retroactive to 2022. And could cost companies like Alphabet, Meta, and Amazon up to $3 billion up front and over $1 billion annually after that. Negotiations have been ongoing, but this was the breaking point for Trump. His response? Shut it all down. Now, Canada's not backing off either. Prime Minister Mark Carney has staked his political reputation on pushing back. This isn't just headline noise. If tensions escalate, we could see fallout across tech, trade, and cross-border supply chains, right when markets were starting to believe in a soft landing and rate cuts. There's a lot of data we could point to as to why the markets have been as strong as they are. All right. I would have to say number one with a bullet is the Treasury market. Take a look at the yield curve, right? And you're seeing 1 month ago and where that yield curve is today. And look at that drop. And in particular, look at the 2-year tenor. That's where traders look at. That's what they look at to get an indication of what the Fed is going to do in the months ahead. Now, Jay has come out in congressional testimony and really hasn't budged. He's indicated that he's likely to hold rates where they are. He says he's data dependent. I'm not sure about that. Nevertheless, the rhetoric between Donald Trump and Jay Powell, pretty harsh. Trump has come at him pretty hard, maybe even more than some of Jay's critics, including yours truly, would like to see. Nevertheless, Donald Trump has a plan, and what he's been doing is getting rates lower by indicating that he's going to nominate a new Fed chair before Jay's term's up. What would that do? All right. Well, if markets start to sense that who the new Fed chair is, and that Fed chair is going to be maybe more dovish and more likely to cut rates, you're going to start to see a reaction in Treasury markets well in advance of that event. And remember, I think Powell's term is up in May. So you would see a move into your 2-year yields on the Treasury side. And that's exactly what's happening. And that's important because there's a lot of debt that's rolling over the next year. In particular, a lot over the next month. And if Donald Trump can get that yield lower, it's going to cost a little bit more to finance it. I think he's going to stay probably on the short end of the curve with new debt that rolls over until he gets what he wants out of the Federal Reserve. And that's likely not to happen until May next year. But it's obviously playing out in futures market, and it's also playing out in probability charts for Fed Fund futures. Take a look at this Fed Fund futures chart from a month ago, all right? And you can see where I've highlighted there September, less than a 50-50 chance of rates getting cut. Take a look at it today, all right? A better than 90% chance that we're going to get a cut in September. And now even July has a small possibility. So the likelihood that we're going to get 2, maybe 3 cuts before the year's out is back on the table. Why does that matter for stocks? Well, we know the market is relatively expensive, but valuations don't live in a vacuum. They live relative to the risk-free rate because that's the alternative asset class, all right? And you look at that chart right there, you can see the S&P 500 is expensive historically. However, if rates come in, that gives kind of a tailwind for stocks. It makes stocks a little bit more attractive, and therein could maybe provide some support and a tailwind for stocks in the months ahead. It's also important for the economy. If 10-year yields come in lower, it's great for mortgages. All right, mortgage rate comes down, more people will buy houses. It's great for your credit card bill. A lot of credit card rates key off of what the 10-year rate is. And that's particularly important for those on the low end of the income spectrum, those who live paycheck to paycheck or who live off their credit card and have trouble paying it off every week because the rates are so high. So it could be good news for them as well. Let's sum up the week. The fact that the United States pulled off an impressive military mission last weekend, maybe bringing an end to Iran's ability to create a nuclear weapon, is a big part of this week's move higher. Even if it turns out that Iran is going to restart their program, the U.S. went in and out undetected without a shot being fired. We'll do it again if we have to. Progress on the U.S.-China trade deal, that was confirmed by China midweek. AI tech optimism, that continues. Even AMD made advancements this week. And the most important AI stock on the planet, NVIDIA, broke to an all-time high. And finally, the odds of at least a couple of cuts this year from the Federal Reserve are rising, acting as a tailwind for risk assets. Are there risks? You bet. And you can never lose sight of that. We live in a very complex world where a conflict half a world away can set off a domino set of events that can take down risk assets in a heartbeat. Size your trades accordingly and resist the FOMO urge of moving out of your risk bucket. If you're 30 years old, then all of your money should be in equity or other risk-on assets. But if you're closing in on retirement or are retired, then make sure you are balanced in your approach with a significant portion of your assets in low risk securities. Do yourself a favor. Talk to an advisor. Well, that's it for this week. Don't forget, if you want to learn more about yours truly or the Money Runner, go to my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is the Money Runner.